Hello again, John Flynn here from Flynn Real Estate, serving Southern Ontario, based out of the Niagara region, here once again to give you my honest and professional opinion regarding the 2022 Canadian housing market. This week, I have statistics from across the country. There's a lot to go over. First, I want to start with some really important news articles I've seen this week, or in the last month, I should say. So let's get right into them before I get into the stats. Starting on November 9th, mortgage lender halts payouts as loan repayments slow. Toronto-based fund defers redemptions amid liquidity crunch. Canadian real estate lender Romspen Investment Corp has halted redemptions on its largest fund after a number of borrowers stopped making payments. So from what I've heard, it was around 40% of homeowners that have private mortgages stopped making their payments or are behind on their payments. And this company was then forced to stop paying out investors their income, right? These are fixed income funds that they're drawing from. So pretty interesting. Let's get on to the next one. Rental housing investor Starlight halts distributions on two funds, citing variable rate mortgage woes. So, of course, these big investors or REITs, these mortgage rates are catching up with them now, and this is what's happening, right? From Reuters on December 2nd, Blackstone's $69 billion REIT curbs redemptions in blow to property empire. Blackstone Inc. limited withdrawals from its $69 billion unlisted real estate income trust on Thursday after a surge in redemption requests, an unprecedented blow to a franchise that helped it turn into an asset management behemoth. The majority of investors redeeming were from Asia and needed the liquidity. So, of course, we have the Asian market issue over there, and they need their money. They need liquidity. Allied Properties REIT explores selling assets worth $1.3 billion to ease debt woes after interest rates soar. This was just on November 24th. And lastly, Starwood, like Blackstone, limits investor redemptions from big real estate fund. So yeah, I just wanted to point all these out. These were all within a month. And a lot of people talk about Blackstone, they set up shop in Canada, in Toronto, actually. And, people think, oh, they're going to buy up all the properties when they drop. Well, I think that they're going to have bigger issues than private individuals because they're more exposed and more leveraged to the market and have investors to pay. So not only do they have bills to pay, but they have to pay investors 9 or 10% or whatever they promised in a falling market. So I think we're going to see a lot more from these REITs and these private mortgage companies now that are leveraged too high. Anyway, let's get into the statistics now, starting in Vancouver. From the Vancouver Real Estate Board, home sales and listing activity continues trending below long-term averages in November. And you can see there, compared to last year, 52.9% down on the sales. So as for sale prices, on detached homes, it fell 2.5% in 1 month from October to November, or approximately $51,000 on the average detached home in Greater Vancouver. And it's 15.2% from April, or 350,000. So I think that's probably the leader in terms of dollar value or dollar figures. The highest figure in Canada is about 350,000 now. It looks like Toronto's 255 or something from the peak. So pretty significant losses, but when you take it as a percentage, not as big as Ontario or Toronto. For the attached market, they had a really big loss in November, minus 6.5% in 1 month, or $79,000, down 12.1% from the peak in February, or $156,000. And the condominium, or the apartments, I should say, relatively unchanged, and they're down 9% from February, $76,000. All right, now on to Calgary. Let's see what's happening over there. 2022 on track to be a record year for sales. Well, this sounds promising. Now, Calgary didn't have the stellar few years that we had in Ontario and Vancouver and the rest of the country. They've been kind of more flat or, very slow growth over the last 5 years or so. Let's see what they have to say about this record sales year. Residential sales in the city slowed to 1,648 units, a year-over-year decline of 22%, but 12% above the 10-year average. So yeah, a little misleading. They're saying it's on a record year, but then they're saying it's slowed 22% lower than last year. Anyway, let's see what the stats have to say. So in Calgary, both the sales have declined and the inventory has declined, but that's normal for this season and this time of year. And the benchmark price continues to decline. Let's look at some other numbers. Months of inventory still obviously a challenge in Calgary. And average prices. So average prices actually declined 3.8% month over month from October to November, $19,000. And no change year over year, flat from last November, and 10.5 from the February peak, or $57,000. So more of a little to gain, little to lose market. But again, like I said, Calgary has been relatively flat for years now, but they did have a peak this year, but looks like they've lost it all now. Winnipeg, I don't have Winnipeg stats. They don't bring them out until like the 8th or 10th of the month. October, I didn't give you those ones either, but I looked at them very quickly. It's relatively flat, the sales and the prices there for October. I would have liked to have November, but anyway, let's move on. Toronto Real Estate Board, or GTA, sales are down year over year, 49.4% and 2.4% for the month from October to November. Prices have been relatively flat for the last few months. They are down 7.2% from previous November 2021, and they are down almost 1% month over month, or $10,000, 19.1% from the February peak, which is $255,000. New listings are down from last November, 11.6%. And of course, the sales to new listings ratio is down 38%. It's 51% now, which would put it sort of in a buyer's market. And of course, the days on market has risen since last year, hasn't gone up too high, but I'm going to talk about that in a minute because they've changed the way they do things. So back to days on market for the rest of Ontario, or almost the rest of Ontario, excluding GTA, about 20 boards surrounding GTA. This is a days on market. This is a 5-year graph or chart. And you can see our days on market is back to about mid 2020, just after the lockdowns ended for the first lockdowns. And it's 34 days on market. Now, one thing I want to talk about, I've talked about it in a YouTube short very briefly, obviously, was we introduced a cumulative days on market in around 2016, 2017, because nowadays, so many people cancel listings and relist after 2 weeks or 30 days. And when it's with the same agent, you have to calculate cumulative days on market. So on a lot of listings, you'll see two numbers here. Obviously, days on market's 34 on this chart. Cumulative days on market's 55. So historically, it would have been a cumulative days on market. But since we relist now with electronic signatures and everything's being paperless, it's so much easier to remove a listing, put it back on, right? So days on market is very skewed, the numbers to a lower days on market. So you just have to keep that in consideration. So we kind of have to look at both metrics. Total new listings are down, but it is seasonal. If you look at all the drops in new listings, they're always in the winter months. And of course, we're in the winter month. We're actually not doing too bad for new listings right now. So here is months of supply. Looking at the trend line, I just put a trend line on here to see where are we for, months of supply historically. And we are back to, late 2019, looking at this chart. So months of supply isn't rock bottom. We're going to touch on this in a moment now with homes for sale to see how this compares. Again, it is a seasonal issue. So here's the homes for sale, very similar to the months of supply chart. And you can see I've tagged all the November spots, and we're actually higher than the last 5 years. And we could go back probably even further than 5 years, but I didn't want to go back too far with the data. So we are a lot higher in November for a number of homes for sale on the market than we have been in the last 5 years. And so when you hear lack of inventory, we're actually not lacking so much inventory in Ontario. Number of sales now, of course, number of sales is low. It's going to be lower in the winter, but we're lower than the last, few years. We'll continue to monitor that. They can only go so low, as I keep saying, but they keep going lower, but they will pick back up sooner or later. And the average sales price, the big one, so 1.1% month over month from October to November. That's about $8,000 or $2,000 a week. Homes are losing, or did lose in November. 9.2% from November last year, or $75,000, and 24.6% from February, the February peak, and that's $241,000. So pretty significant losses in prices there. On to Quebec. Again, Quebec is more of a little to lose, little to gain market when you compare it to Ontario or Vancouver. Their prices didn't shoot up like ours did, but let's see what's going on there. Property prices are holding up in the face of a drop in sales. And this is just for Quebec City. The market slowdown grows in Quebec City, moving toward the normalization of transactional activity. Okay, let's see how the numbers look. The average days on market is obviously starting to creep up. It's over, what, 45, almost 50 now. I think it's about 47, I think the average was. But we're approaching 50, so they have a lot higher days on market than a lot of other places in Canada. The province of Quebec median single-family prices relatively flat for the last 3-4 months. Of course, it is down 60,000 from the peak. Province of Quebec condominium prices, median prices, again, relatively flat. They are down from the peak, but they're flat for now. And in Montreal, let's check out Montreal. Again, relatively flat. It's gone up and down month to month, but nothing significantly. Down about 60,000 from the peak, or just over 10%, 10 or 12%. Condominiums, very flat, exactly 380,000 for the last 3 months. Again, down from the peak, but we'll see how that fares in the winter months. And lastly, Halifax from the Andrew Perkins real estate team is where I get the information. Let's see what they have to say for November. Sellers' price adjustments are to be expected. That being said, if you have owned your property for longer than 5 years, you should make a great profit. We are still far away from a buyer's market, with only approximately 2 months of inventory currently on the market. So it seems like sellers, you could still sell, and buyers, it's still not your market. So anyway, let's look at the numbers and see what it says, or see what they say. So here's the average price of single family homes in Halifax. And of course, it's been going up and down like a yo-yo for the last few months, down 40,000 from the peak. That's less than 10%. Of course, Halifax doesn't have a great number of sales, so their numbers will fluctuate, but it seems to be mainly consistent numbers and consistent prices for the last few months. They do have an inventory issue there, and not a great number of sales, really. But let's check out the condos. Condominium market seems to be following that same trend, but it is down. Looks like it is almost 90,000 from the peak. And it had a good October, November, but I don't see that lasting throughout the winter months. But yeah, we'll check back on that. So that's it for the stats. Of course, we have a big announcement tomorrow. Markets already reacting, stock markets already reacting with the potential increase, another increase, and more than expected, less than expected, who knows? And we'll see. We'll talk about that next week. But as always, leave your comments, questions below. And thanks for watching. I'll see you next week.